Welcome to Wall Street Week, the show of record for long-term investing. I'm Gary Kaminsky.
And I'm Liz Klayman. Anthony Scaramucci is going to be back next week.
Our first guest, Joe Grano, says after the election, look out below. Joe is the CEO of Root9B, as well as the former chairman of UBS. We welcome him to Wall Street Week. Joe, great to see you.
Good to see you, Gary.
You know, Liz, I was just thinking, this week, coming up, the 8-year anniversary of the collapse of Lehman Brothers, the beginning of the financial crisis. It seems in some ways like it was just yesterday.
It does, and I know a lot of our viewers, Gary, are sitting here thinking that they can't believe it's 8 years in the rearview mirror. Gary and I were talking minute by minute back then.
Yep.
I was out on the West Coast, and we were thinking, will it happen? And then I got the call. Lehman will file for bankruptcy on that Monday.
Yep. And you broke so many stories. You know, Joe, the market is up 150% or so, the S&P, since that bottom in 2009. And it's been quite a run. But you're worried about what's going to happen after this election. Share that with us.
Yeah, for several reasons. I'm not confident in terms of sustainability. So why is the market hitting all-time highs? First, in the land of the blind, the one-eyed man is king, that's the United States. You've had over $400 billion of direct foreign investment come in the last year. And then you look at the companies hitting their earnings, and part of the reason for that, we have record buybacks of stock, $589 billion in the last 12 months. That supersedes 2007, just to put that in perspective. And of course, you have zero cost of money, which are the reasons why corporations are hitting their earnings. But if you look at the revenue line, majority of them are not hitting revenue targets. So that's not sustainable. So that's very concerning to me. And I think confidence is a big, important factor. You have tremendous amount of, let's call it event risk with ISIS, et cetera. And we have an election with the two most unfavorable candidates in my lifetime. And that doesn't exude a lot of confidence for the nation.
Let me play devil's advocate.
Sure.
A lot of people have made a lot of money on those exact fears in different iterations over the years. You know, since they've been keeping records of these things, you ask people and businesses, what's the most dramatic thing that's keeping you from investing? Going back 50 years, they've said uncertainty, elections, problems overseas. So what makes you think that this time is different, that we will see, and you've said it, a 10 to 20% correction? That's a major Lehman-type market event. Well,
I think that's the vulnerability we have. And a 20% decline in the Dow brings you to 15,000. That's not so bad. Right now, the Dow's price-earnings ratio is over 20, S&P 500 over 25. And those are not historical standards in terms of a PE ratio. But more importantly, I can't disagree with your historical perspective, but frankly, I think that the economy is more anemic than we're being told. I think it's a bit of a head fake. I think the unemployment rate is higher than being announced with people who part-time or came off the rolls. I think it's closer to 9%. And if somebody were to say to me, Joe, I'll guarantee you a 2% GDP growth for the next 4 years, would you hit the bid? I'd hit the bid right now.
So, Joe, you mentioned about the unfavorability of the candidates. So the election happens. You think that's when the market wakes up to the reality. We've now got this situation. We've got the Fed behind us in terms of what they've been able to do. The market then has this correction. You say, what, 10 to 20% correction?
I think that's the range that could happen. I'm not predicting it.
Right.
I'm saying that's the vulnerability.
But investors should be concerned and aware of it.
I would say more likely than not. I'm willing to say
Well, you know, you mentioned a bunch of things that you point out are helping levitate the markets. You know, one thing that we didn't talk about is negative interest rates.
Yep.
And one thing that stood out to me, Liz, this week is that you've had major French and German companies issue corporate bonds with negative rates. Now, what does that mean for the public? That means that not only are you giving these businesses your money, you're actually paying them to return you the principal.
That's correct.
When I think about this, Joe, put on the old Paine Webber hat. I mean, a lot of viewers out there know, you know, you were one of the men who helped create the wealth management industry. What is this negative rates? This can't end well. Can it?
No, I mean, look, I saw it firsthand when Switzerland had negative interest rates. I remember talking to clients, get your money out of there.
Yep.
So it's going to impact liquidity for sure, ultimately. But you're right. You're giving a German corporation your money at a ½ point cost. So you're going to get back less than you gave them.
Right.
And I don't consider that sustainable. But if you agree that markets, to some degree, are predictive for what's going to happen economically, we normally say 6 months in advance. Well, what is the market saying to you that a corporation in Germany will take your money and give you back less? What does that say?
Okay, so the cost of money is zero. people look at that and say, the Fed-induced sugar high ceases to work anymore. It doesn't have the same effect. So make your list. What new market drug, Joe, would actually have an effect and help the economy and help the stock market make new highs?
Great question.
Well, I think it would start with a president who can lead. We need leadership. This country needs to coalesce. There's been more racial divide than I've seen in decades. I think we need a president that gives us a foreign policy that has certainty. I think we've been wishy-washy. I think we've stepped back a couple of decades. And I also think we need to understand the pillars underlying the problems in our own nation. Unemployment, housing still in terms of foreclosures, and the American dream in the United States has always been manifested in the House. And that's been shattered. That's the number one breakup of the middle class, the fact that that house doesn't go up every 7 1/3 years and you can raise it up and sell it and there's your nest egg. And Social Security is another one. So I think we need to address those issues with solutions. And we're not doing that. And there is a solution, by the way, for every one of those.
So who are you supporting in the election that you think can give us that leadership?
I am at a tremendous, I have a dilemma. I obviously don't trust Hillary. And Donald Trump, who I've maybe had interactions with 3 or 4 times in my life, he's not the same person, at least from what I'm seeing. And I want to see that man come back. He is articulate. He's smart. Yes, he has an ego bigger in this room. But he's a good businessman and a professional. That's what I need to see again in order to be able to make that vote. And we're running out of time.
All right. Well, Joe, thank you for your guidance and your wisdom on that. As always, great to see you.
My pleasure.
Wall Street, we will be right back.